Smart Money Concepts, the complete beginner's guide. In this video, you will learn the 3 core SMC patterns, how to manage your risk like a professional, and the psychology that separates winners from losers. Let's get started. Smart money refers to banks, hedge funds, and large institutions. These are the players who actually move the market. They leave footprints on the chart, and SMC teaches you how to read those footprints and trade alongside them instead of against them. The first core concept is the order block. An order block is the last opposite colored candle before a strong displacement move. This is where smart money loaded their buy or sell positions. When price returns to this zone, it often bounces because the institutional orders are still sitting there. The green zone you see on this chart is a bullish order block. Notice how price displaced aggressively upward right after it. The second concept is the fair value gap, or FVG. This happens when price moves so aggressively that it leaves a gap between the wicks of candle 1 and candle 3. The wicks don't overlap. This gap represents an imbalance in the market, and price has a natural tendency to come back and fill it. Think of it like a magnet. Price wants to return to these zones before continuing in the original direction. The third concept is break of structure, or BOS. In an uptrend, a break of structure happens when price breaks above the previous swing high. This confirms that buyers are in control and the trend is continuing. In a downtrend, it's the opposite. Price breaks below the previous swing low. BOS is your trend confirmation signal. Never trade against the direction of the most recent break of structure. Here is the complete SMC entry model in 4 steps. Step 1. Identify the trend using break of structure on the higher time frame. Step 2. Wait for price to pull back to an order block or a fair value gap. Step 3. Look for a lower time frame confirmation like a change of character or a displacement candle. Step 4. Enter with a tight stop loss placed below the zone. This 4-step process keeps you disciplined and eliminates emotional entries. Now, the most important section, risk management. Rule 1. Never risk more than 1 to 2% of your total capital on any single trade. Rule 2. Always set your stop loss before entering the trade, not after. Rule 3. Maintain a minimum risk to reward ratio of 1 to 2. Ideally aim for 1 to 3. Rule 4. If you lose 3 trades in a row, stop trading for the day. Your mind is not in the right state. Rule 5. Never move your stop loss further away from your entry. That is the fastest way to blow your account. Here is the difference between disciplined trading and gambling. A disciplined trader risks 1 to 2% per trade, always sets a stop loss, accepts small losses as part of the game, and follows the trading plan no matter what. A gambler risks 10 to 20% hoping for a big win, trades without a stop loss, revenge trades after a loss, and makes decisions based on emotions. Which one do you want to be? Now, let us talk about trading psychology. Your biggest enemy in trading is not the market. It is your own mind. Fear makes you exit winning trades too early because you're scared of losing the profit. Greed makes you hold losing trades too long because you refuse to accept the loss. The traders who succeed are not the smartest or the most talented. They are the most disciplined. Discipline beats talent every single time. 5 psychology rules every trader must follow. Rule 1. Never trade when you're angry, stressed, or right after a big loss. Your judgment is compromised. Rule 2. Keep a trading journal and review every single trade honestly. This is how you improve. Rule 3. Focus on the process, not the profit. If your execution is good, the money will follow. Rule 4. Accept that losses are completely normal. Even the best traders in the world lose 40% of their trades. Rule 5. Take breaks. Trading every single day without rest leads to burnout and terrible decisions. Your SMC starter checklist. 1. Learn the 3 core patterns: order blocks, fair value gaps, and break of structure. 2. Always trade with the trend. Never trade against the higher time frame direction. 3. Risk only 1 to 2% per trade, and always set your stop loss before entering. 4. Aim for a minimum 1 to 2 risk to reward ratio on every trade. 5. Master your emotions before you try to master the market. Psychology is 80% of trading success. Practice identifying these patterns on the SMC ChartSense app. It is 100% free, works completely offline, and requires no sign-up. Check the description for the download link. Subscribe to SMC ChartSense for more educational trading content. New videos every week. Remember, this is education only, not financial advice. Always do your own research and consult a SEBI-registered advisor before trading.